Hello, this is Ride or Die with rideordieinvesting.com. Today, I'm here to talk to you about earnings per share and revenue, and what is better when you want to value a company. So, to put it simply, earnings per share is basically net revenue or net profits divided by shares outstanding. So, to put it simply, it's all the different stuff, all the different profits that the company makes after taxes, after paying their employees, after all the goods and services that the company has to pay for every year to sustain their business. One of the problems with investing solely on earnings per share, which is something that I would not recommend, is they can doctor, the corporations can doctor their earnings just by reducing share count, which basically gives every individual share a bigger piece of the pie, which increases earnings per share, while actual income, net income, stays the same. Revenue is basically everything that the company makes before all the different stuff is taken out. So you could be investing in a very, very capital intensive company that basically uses up all their revenue, and in the future, when there's a recession or a downturn, that company goes bankrupt because they don't have anything left over. They don't have any free cash flow. They don't have any earnings per share. They don't have anything. So again, just because their revenue is increasing every year, year over year, does not make it a good business. Obviously, that's not the only thing that you should look at with earnings per share. There's other stuff you should look at, again, like free cash flow. You should look at ROIC, return on invested capital. You should look at beta, which is something I'm going to go and talk about in another lesson. But at this point, we're just looking at revenue and earnings per share. An example of a person that has used earnings per share to great effect is someone called Peter Lynch, who wrote Beat the Streak. He uses the same way of valuing companies as a company that I use a lot called fastgraphs.com, which tracks the linear progression of earnings over the course of the last 20 years. And it's a very unique and very useful tool for people who are trying to figure out how volatile a company is. If you want to get into something like commodities, then you're going to be looking at a lot of ups and downs throughout the last 20 years. And you can see that when you look at fastgraphs.com. If you want to go into more consumer staples, such as Colgate, Johnson & Johnson, a bunch of other stocks similar to that, Coca-Cola, Pepsi, anything to do with the consumer or consumer discretionary, Philip Morris, Altria, you're going to be looking at a very nice increase in earnings per share every year. Again, that's not the only thing that you should look at when you're looking at valuing a company, but that's definitely one of the things that you should look at. And again, some people might say that, oh, well, Amazon increased its revenue every year by 40 or 50%. Well, they had no profits, and they're still around, and they made investors a ton of money. Well, that's just one company that did that. For every one Amazon, there might be 20 or 30 other companies like Sunkist, Microsystem that did the same exact thing, and they all went bankrupt, and they're no longer here with us. I like to think of investing as more of just investing in a company and hoping that it does well and having like actual products that you're investing in. And don't think of it as gambling per se. Think of it as looking at the actual fundamental aspects of the company and investing based on those until something about the company changes, which then, in that case, you should no longer look at that company or sell it. But when they're actually increasing their earnings per share every year, example would be Apple, would be Visa, would be MasterCard, would be Microsoft. All of them, they've been increasing their earnings per share very steadily, and looks like they will be doing so in the near future and hopefully in the foreseeable future. So that ends my lesson on earnings per share and revenue. I'm going to be doing more videos in the future on stuff like beta and stuff like return on invested capital. But at this point, we're just going to be focused on earnings per share and revenue. So thank you for looking at my video. Please like, please subscribe, and this is me signing.